Hello and welcome. This is Dan Havey from FinServ Analytics, here to talk to you about CECL Clearinghouse, a subscription service that will calculate and report on your current expected credit losses. The genesis of CECL Clearinghouse started when the pronouncement came out a couple of years ago, requiring banks and credit unions to come up with a way to forecast their future losses based on their current loan portfolio. One of the problems early on that was recognized by many folks is in order to predict something, you need to have good data as a basis for it. And many banks and credit unions trying to predict future credit losses just don't have enough past write-offs, charge-offs, etc. to have a good data to predict those future losses. So the need is to borrow other people's losses where there's a wealth of information. So what CECL Clearinghouse has done is gone back, or FinServ Analytics has gone back and reviewed all the call reports from the credit unions and banks for the past several years. And there's a wealth of past due information, loan information, charge-off information. Now that only provides a high-level foundation, but what we've done is we've gone back to many of our clients where we have very granular data, where we're calculating customer profitability, funds transfer pricing information, have loads and loads of data that will predict stuff at a very minute, at the granular loan level. But the genesis, the whole thought process of CECL Clearinghouse is let's start with other people's loss history to help predict your loss history. The way we approach the loan loss reserve today is a pronouncement called Allowance for Loan and Lease Losses. Essentially, we've been looking at past charge-offs. We break up our portfolio into functional pieces that pretty much mirror the call reports today: credit cards, leases, commercial loans, vehicles, properties, that type of stuff. And in this example here, you can see credit cards have been losing about 3.5% a year, leases 21 basis points a year, etc. And we just simply cross-multiply our past loss experience times our current loan portfolio, so that'll come up as a proxy for what we expect our losses to be in the future. That worked well for many, many years. But then came along the financial crisis back in 2007 and 8. The issue was there were a lot of mortgages being underwritten. Mortgages are always a safe bet. And the past charge-offs will be, we're lucky for them to go higher than 20 basis points, a very good loan. But in 2005, 2006, a lot of banks were underwriting lots and lots of mortgages and selling them in the open market. And they weren't doing income verifications, good underwriting standards, things like that. But they didn't care. They were trying to get the origination fee, so they would underwrite the loan and sell it as fast as they could. When the interest rates started to tick up in 2007 and 8, all the 3-1 ARMs, 5-1 ARMs all of a sudden repriced, and the price went up a little bit as far as monthly payments. And all these folks that were poorly underwritten all of a sudden could not afford the new payments. And then it just started a cascade effect. So the pronouncement basically says, okay, don't look at past loss. We want you to look at the loan itself and try to figure out what the likelihood of that loan is to be charged off in the future. And once you do that, you create all sorts of issues. So right away, you've got a lot of folks coming up with ways to predict future loans. And they've got models that says you need R50 data variables, you need this, our methodology, all sorts of ways. So you just have many folks coming at you with good models, but a lot of them are very complicated, hard to implement. And what we have today is just a lot of folks with analysis paralysis. They really don't know where to begin. So what I'm going to do is press the pause button, slow it down, and take us back to our first year of college, maybe last year of high school, and talk about Statistics 101. And here we're looking at a classic bell curve. And let's say the results, this bell curve is the results of a model that's trying to predict loan losses for your bank. And it basically says we expect losses to be $100, give or take $15 with 68% of confidence. Or we expect the losses for your bank to be $100, give or take $30, with the 98% of confidence, a 95% degree of confidence. And as you can see, the further out we go, the confidence goes up, but as our standard deviation, if you will, gets wider and wider and wider. So what we're looking to do is come up with a model that has a high level of confidence, but not that many standard deviations away from what we're trying to predict. So another observation about this bell curve is we could say, let's say we have a two-factor model and that we're trying to predict losses. If you come up with two really good factors, you'll probably be a model that's right 68% of the time. If you add two more factors, you probably get a model that's right about 95% of the time, and so forth. One of the observations you'll notice is we keep adding factors, we get less and less of a lift as far as our confidence. So what does that mean? You only need a handful of factors to really come up with a good predictor of future losses. You don't need dozens and dozens. So if you only have two to start with and you do have a lot of data on your own, probably the two best ones to predict future losses are going to be loan to value, something about the loan. So if it's a collateralized loan, secured loan, obviously loan to value. If it's an unsecured loan, maybe loan to the credit limit. But that tells you a lot about the loan itself. And then the second one, the FICO score, or maybe if you're in commercial loans, you got a risk rating, but something about the borrower. If you have those two scores alone, you probably come up with a pretty decent model if you got enough data. But therein lies the problem. Many banks, especially those under $1 billion, have been very good underwriters these past several years. They just don't have a lot of data points to come up with a good predictive model. So once again, we're going to borrow lots and lots of data from many banks and credit unions and help use those data points to help predict your losses. So what did we come up with? Here's our current inputs, if you will, to the model that's going to help us predict your loan losses. Then we started with 30 variables and we whittled it down to 20 and to 10, and then we finally got it down to this handful of variables. Very easy to get to for your bank. But first of all is the analysis date. What's the date that we're going to use to analyze your data? The way CECL works is as of certain date, we're predicting current expected credit losses on this portfolio. It assumes you stop making loans, and we're just trying to say from this day forward, what are the expected losses? So the date could be May 17th, July 4th, doesn't really matter, but obviously most folks would rather want the analysis done on month end, so it'll sync up with their financial reports, specifically on quarter end match up with the call reports. Second item is the loan number, a unique identifier. It could be customer dash note number, but some type of number or key, whereas we calculate at the loan level, we'll have something to write it back to. And that's going to be important when we do all our reporting later on. Obviously, we need to know the current balance of the loan. If it's a credit card with zero balance, there's no risk. You just stop issuing any advances to that credit card to shut it off for CECL purposes. So obviously, we're only interested in loans that have balances, but they can be participation loans, your loans coming from your core, maybe loans that are being serviced by somebody else, like a credit card portfolio, but obviously current balance. The loan type is going to be the traffic cop. That's the code, the collateral code, purpose code, call report code. But this is going to tell us what model to use. So obviously for car loans, real estate loans, commercial loans, those types of things. But that's going to tell us what model we need to use. Next one is the origination date. How long has the loan been on the books? The longer it's on the books, is that a good thing or is that a bad thing? It depends on the loan. Obviously, if it's a credit card and it's been on the books for a long time, that borrower is clearly proved that they can handle revolving credit. So the age of the loan does have a bearing on the risk. What was the original amount? Obviously, are you paying that loan down? Or is it an evergreen loan that's never going to get paid off and eventually just charged off? But we need to know the original amount. If it's an unsecured loan or like a credit card, we'll just take the credit limit as the original amount. Column G is going to be the collateral value, obviously for secured loans. What was the value of the home, the value of the car, the value of the commercial property, whatever we're looking at. But once again, if it's an unsecured loan like a credit card, just what's the credit limit? We'll take that number again. Column H, when was the last time that loan made a payment? Obviously, if a loan hasn't made a payment in 180 days, odds are it's already going to be charged off. But not all loans. It could be a PPP loan where they're not being charged off. It could be a PPP loan where it's not really charged off. It's just simply waiting to be forgiven. Or it could be an agricultural loan where they make payments basically once a year, right after the harvest comes in. So, but the last payment date obviously has a very big bearing on the riskiness of the loan. What's the interest rate? If you have 2 car loans, everything's exactly the same. The collateral amount, the term, the FICO score, all that stuff. But for one reason, one borrower was charged 6%, another borrower was charged 3.5%. There's something about that 6% loan that your underwriter saw as being a little bit riskier. So obviously interest rate has a bearing. And then finally the FICO score, or if it's a commercial type loan, maybe the risk rating 1 through 8, A through H, that type of stuff. But as you can see, very straightforward, easy to get variables that are all very good predictors of probability of a loan being charged off. So what we do is we take your data. It's never going to come in one file. Obviously, we're going to get data from your core. We're going to get data maybe from your credit card provider, maybe participation loans. You got various pools that were purchased loans, that type of stuff. But what we're going to do is we're going to take all the data you send us and sort of mesh it into a file where we come up with these factors. Now, we're going for 99% plus confidence. We know in many, many cases you're not going to have all the loan details. You might not have FICO scores for credit cards. You might not have collateral values for older homes, those types of things. But we have all sorts of algorithms to fill in the blanks. But we just need to get your data as close to as possible, and then we have lots of ways to fill in the blanks full of assumptions. So what we do is we transform the data. Then next step? The next step then is we take your data, and based on the purpose code, collateral code, type code, we're going to pick the model and run it through the model and all the various models, and we're going to append a probability of that loan being charged off over the next 12 months. So here's an example of say, the car loan model, where each of these variables has a coefficient. In linear progression, probability analysis, we're going to take each of the factors, 1900 loan balance, 15% loan to value, 680 FICO score, 20% loan to original balance, 725 the interest rate we talked about versus the Fed funds rate at the point of origination. How old is the loan in years, and when's the last time they make the payment? So we're going to go ahead and cross multiply it against those variables and come up with these amounts, 6 digits. We're taking it out to a precision of 6 and add them all up, and that's going to be your probability of that loan being charged off over the next 12 months. So this first car loan, 37 basis points probability. Second car loan, different variables, same coefficients, but we come up with a 3.7% chance of being charged off. So that's what we're going to do is we're going to write these, go through each one of your loan portfolios, pick the model, and come up with a probability of default. Down here below is a little bit of commentary on how the coefficients behave. So in the car loan, obviously, the loan value increases, the CECL amount increases. Loan to value increases, the CECL amount increases. However, your FICO score increases, we're going to lower the risk of CECL. If the loan to origination balance increases, it decreases. So that means it's closer to when the loan was originated. Younger loans have a lower probability of being charged off for car loans. As your interest rate decreases, so does the probability of CECL decrease. As the loan age decreases, or basically the closer to origination point, the higher the probability of that loan being charged off. So young car loans have a higher probability of being charged off other than ones that have been on the books for a while. And then obviously, when's the last time they made a payment? The longer it's been, the higher the chance of that loan being charged off. So we run all the models, we run all your loans, and at the end of the day, we're going to append that probability of default over the next 12 months against each and every one of your loans. Next thing is, how long are these loans going to be on the books? So obviously we have to take your car loans, your first deed of trust, those types of things, and essentially come up with a decay rate. So we're going to take your whole portfolio, break them up into various layers and the age of their months. What was the original amount? What's the current balance? And then obviously what's been the monthly decay rate, with your own internal portfolio. And then what we'll do is we'll seek or come up with a formula that if we plug it in and say, okay, we take your original balance and we multiply it by the number of months it's been on the books. In this case, it amortizes 1.5%, a little more than 1.5% a month. We're basically going to replicate the exact way your portfolio is behaving. So that is the decay rate of your portfolio. So why is that important? Because we've got to take your current loan balance at $115 million, and CECL says what are the losses over the life of that loan. So what we got to do is project forward balances using the decay rate that's actually inside the portfolio. So that's step number one. Number two is we got to deal with prepayments. We obviously know that not all the loans are going to stick out the full term. They're going to be charged coming off the books earlier than expected because of prepayments, those types of things. So what we do is we take the weighted average life of this portfolio in months. In this case, it's a little, it's about 18 months. And we multiply it by 2.25 and basically say, okay, after 39, let's say 40 months, the odds are that that loan is going to prepay, based on this portfolio. So we just simply take your decay rate, look at each and every loan and say, okay, 12 months from now, it's going to be 81%. 24 months from now, it's going to be 67% of that balance, 56% and 46%. We take 2-month-old loans and then multiply it by the same rates. But essentially, we're coming up with a forecasted balance out in the future years. And then once a loan passes the 40-month mark, it comes off the books. Or said in other ways, this $115 million in loans over the next 4 years will amortize down to $84 million with prepayments in there, $61 million, $36 million, and finally below $9 million. Now we stop at 4 years. We can go out 5, 6, 7, 8 years. But as we all know, one of the pillars of any financial accounting standard board pronouncement is this idea of materiality. And it essentially says they don't want you to spend $1 million chasing down $1,000 worth of risk. It's just not worth it. So we just stop at 4 years, but obviously, we could go out 5 and 6 years, if the client, needs it. But the balances are amortizing so fast, the fifth year on this scenario is going to be, less than 2%. So it's not even worth tracking. So if we add up these balances and compare it to the current balance, essentially it's 1.66 times that current balance. So we're going to cross multiply every single loan, take it against its future forecast, and multiply those probability defaults in year 1, year 2, year 3, and year 4, and cross multiply it against all those balances. Then we go ahead and prepare your reports. The first report is basically going to take this current loan balance based off the 4-year forecast. If you open up or expand the columns, you'll see the 4-year forecast. But essentially, this 631 is going to amortize and prepay down to $500 million, $350 million, $200 million, and maybe $40 million. We're going to cross multiply each one of those loans by the probability of default and come up with expected losses in year 1, year 2, year 3, and year 4. We add up those 4 years of losses and come up with $8.7 million in this case here. So that $8.7 million as a percentage of the current balance is essentially 1.39%. Those would be your CECL amount, your loan loss reserve. We say set up a reserve for 1.39% of your balances because we based on the current expected credit losses over the remaining life of the loans. For giggles, we compare it to the trailing 12 months of charge-offs because we know that we're still going to be looking at all that information. How does it compare? And so in this case here, that they've had $5.7 million of charge-offs in the last 12 months, or 91 basis points. So when we compare the CECL projection versus the trailing 12 months, we typically are going to see a multiplier of anywhere from 1.5 years to 2.5 years. And that's very, very consistent across all the banks and credit unions we've won into. Obviously, they're going to be outliers. If the current expected credit losses is less than those trailing 12 months, they've done something different. Either they had a single huge credit that charged off, that ain't going to happen again, or they've taken preventative actions. They may have hired collectors, but there's always going to be a reason. But if it's the comfort level is anywhere between 1.5 to 2.5 times. So this is definitely within the comfort level. Second report is that vintage analysis. Is very, very helpful. It's easy on the eyes, but it's really good in reconciling these future losses. And all we do is we take each one of these individual loan types and then turn them on their side, and basically what does it look like over the next 4 years, but based on the year it was originated. So in this case here, we're looking at dealer loans. Total amount, current balance of $290 million. When it was originally put on the books, it was $373 million. So we take our amortization / prepayment forecast and we march it out over the next few years. Then we compare it to the trailing 12-month charge-offs. There's our number there. And then these are the expected losses over the next several years, next 4 years. So it's just simply the cross-multiply probability default against its balances over time, and now we got 5.4 million. So that's our vintage analysis report. Very helpful, very good for reconciling. The third report is the trend analysis at a high level. In this case here, we're looking at mortgage, just high-level categories. Mortgages over time, consumers, commercial, credit cards, whatever their portfolios are, they just don't have credit cards in this portfolio. And what we're looking for is consistency. We don't want to see erratic behaviors. There may be changes if a lot of past dues all of a sudden crop up, or they're originating heavily in a very risky loan type. But you're going to see the portfolio react to those changes over time. They're going to start moving pretty quickly. But here we see, there's current expected credit losses, as a percent of mortgages. It's basically very steady, 35 basis points, 36, 35, 36, and that's what you want, is steady as she goes, not a lot of movement. Consumer loans, same thing, but you can see it's actually come down some. They've made some aggressive improvements on, collections, getting loans, out of the past due buckets, and you can see the effects of them, improving their collections on loans. Same thing with commercial loans, nice, steady, smooth, 59, 55 basis points, 55, 54, and so forth. So this is going to be your trend analysis at a high level. It's going to be very crucial as you're paralleling. Before you fully adopt CECL, you're obviously going to want to parallel and compare it to where you're currently calculating your loan loss reserve. But after a few months, it might take you all the way up to December of 2022, but eventually you're going to flip over, and you're going to want these numbers to be pretty much in sync. You don't want any surprises, any financial impacts. From our clients, we haven't seen that either. It's been pretty smooth. The way they've been currently calculating their allowance loan for losses typically is coming very close to what the CECL is projecting. We just haven't seen a lot of negative results when implementing CECL, especially when you parallel. We're going to be obviously tweaking our model, making adjustments, fine-tuning it month after month after month. But once you finally adopt, there shouldn't be any big financial impact. Next report is the trend analysis at a very detailed level, obviously by the loan, the purpose code, collateral code over time. So in this case here, again, we're looking at those dealer loans going from 245 million up to 290 million. So this bank's been investing heavily in dealer loans, growing them aggressively. So you can see, there's movement moving around because each month they're adding another big layer of new loans, and each month that new loan layer might have lower FICO scores, have higher FICO scores. It just depends, but it's just simply reacting to the data. Down below is just a quick and dirty chart that helps us navigate, the coverage. based on, and one of the factors that's moving it the most is the average days of collection. You can see been taking around 19 days basically, November, December, for those payments to come in, and then they've made some heavy improvements. February is always a shorter month, so you always get a day pickup there. But even out to March, it's still improvements, less than 19 versus December. So that's it, basically. And then there's another report that's going to track impaired loans. You set aside a specific provision, but you want to see what the CECL analysis says. And that'll typically be an adjustment because your impairment is going to overrule whatever we calculate for CECL purposes. You know more about your credits than any computer model will know. Those are the 5 basic reports. As regulators continue to make comments and auditors review our reports and they want more information, we'll obviously add another report to the package, add more ratios as needed, but that'll just come automatically. The goal here is for us to do the heavy lifting, calculating all the CECL numbers and satisfying the reporting requirements. Thank you for your time. Again, this is Dan Havey from FinServ Analytics. There is my contact information. If you'd like to learn more about our subscription service, by all means, reach out to me. We always offer the first analysis for free on a complimentary basis. The goal here is to learn your type codes, make sure the model's calculating properly, you get comfortable with the number, get that initial assessment. But that's where all the hard work takes place, is during the complimentary phase. Once you sign up to be a customer, obviously we just simply get the files from you, do all the reports, and we turn it around very, very quickly, 1 to 2 business days. But we got to do that complimentary analysis first to set you up into the system. And then if you should decide to sign up for the subscription service, we're going to turn it around within 1 to 2 business days. Thank you again. It's been my joy and pleasure walking you through CECL Clearinghouse, and looking forward to hearing from you soon.